Ian Quigley, senior consultant with the innovative financial advice firm Cube Consulting, presents a breakdown of the 2011 federal budget.
The 2011 federal budget is actually a very interesting document. Many have looked at it and they've deemed it what they call a status quo budget, a budget that doesn't really change anything significantly. There's no new taxes for individuals. There's not a repeal of any previously announced tax reductions. The finance minister introduced it as, in quote, the next phase of our economic action plan. But in reality, there's some very noteworthy changes that are happening in this 2011 budget. One of the things that's happening is the government is announcing a review of its spending programs. They want to increase efficiency and effectiveness of government. And in Canadian history, this is kind of scary talk for civil servants. It actually is a preamble to potentially revamping many of the government ministries and their particular budgets. But what I want to talk about here is another key aspect of the 2011 federal budget, which is a very aggressive movement by Canada Revenue Agency to close down what they call tax loopholes. So technical changes to shut down creative tax planning. And in particular, I'd like to point out 7 tax strategies, or what CRA is calling loopholes, that they're identifying in this budget and going after. And the first one is corporate partnerships. Corporate partnerships have been used in Canada for a number of years now, fairly recent, but they're a creative way for corporations and individuals to form associations for business purposes under what are called the partnership rules, and then to do some creative sort of tax planning. So this budget is the beginning of probably a whole series of change by CRA in trying to sort of unravel what we call the partnership tax planning. And in this particular budget, they have a whole series of technical changes on how they're going to require those in partnership arrangements to report for tax purposes and the rules around that. So if you know of taxpayers that are forming partnership arrangements, then this budget is definitely going to impact them and going to require some additional study. The second item I want to point out is in insurance taxation, which are the stop-loss rules. Stop-loss rules were introduced in 1995. They were a massive change in tax policy that we saw in insurance taxation in the mid-90s. And since 1995, tax planners have been working around what were called the stop-loss rules to continue to offer taxpayers a deferral of income tax to the next generation of shareholders at death. So it was really a very strong and creative amount of work that's been done to kind of get around these 1995 rules. And so this federal budget here has a whole bunch of technical adjustments to really unravel and to battle those that have created the workarounds of the 95 stop-loss rules. So for estate planners working with small business owners on estate planning, this budget is going to fairly significantly impact those tax planners. Number 3 are the employee profit sharing plans. Employee profit sharing plans really come from legislation that predates the 1960s. It's legislation that was originally designed to start helping employers create retirement schemes for their employees, and then EPSPs, or employee profit sharing plans, have sat kind of unused for decades. And around about 1999, they started being used by some creative tax planners as a way to get T4 income to employees, but not having to attract CPP or EI premiums. So this was sort of an avoidance scheme on CPP and EI premiums, and there were some other income splitting strategies used as well. So in this federal budget, the feds haven't actually said what their technical changes are going to be, but they've notified taxpayers they're going to be targeting EPSP programs and shutting down these workarounds on CPP and EI. So another fairly significant technical adjustment for tax planners that work in sort of compensation areas. Number 4 are donation schemes. This is a battleground that CRA has been fighting for a few years, very aggressively going after tax schemes that have been created using the charitable donation credit. And some of these schemes were the sort of buy low, donate high strategies, where you would buy drugs or art at wholesale prices and then donate them to charity and have them valued at full fair market value. So CRA has been after this one for a few years. And in this particular budget, they're homing in on the charities themselves versus the taxpayer claiming the credit. They're going after charities and tightening up which charities can offer receipts, and then also tightening up the amount you can put on a receipt with regards to what are called non-qualifying securities. So these are sort of transactions of shares between non-arm's length taxpayers, and then more significantly going after donations of publicly listed flow-through shares, a very common or becoming a very common tax planning scheme in the last couple of years. And so any taxpayers that are working with charitable giving strategies, they're going to really want to have a look at this budget and some of the technical changes, because CRA is definitely tightening their grip on the creative planning being used in the charitable donation arena. That takes us to number 5. They're going after RSPs this year as well. And in recent years, there's been some schemes that have developed to allow taxpayers to get money out of an RSP account tax-free. So they're called sort of RSP stripping strategies. This has irritated CRA because the intent of an RSP is to defer tax and then create taxable income during the retirement years. So in this federal budget, they're taking a fairly aggressive movement towards RSP programs and setting up actually 3 new sets of rules, anti-avoidance rules, similar to what they had done with tax-free savings accounts last year. And these anti-avoidance rules break into what are called the advantage rules, the prohibited investment rules, and the non-qualified investment rules. So the point here is if any creative tax planning is being considered with RSP accounts, getting money out of an RSP tax-free as an example, the 2011 budget is going to be focusing in on that as well. Number 6 are individual pension plans. In this instance, the budget is targeting small pension plans. These are the defined benefit pension plans that many small business owners have started using in Canada in the last 5 years. And they're really targeting these particular pension plans and saying that when you get to retirement, you cannot use one of these pension plans to reduce your income below what you would have had if your retirement money was in a RIF. And that really doesn't sound all that unfair, and there hasn't been a strong reaction against that particular budgetary change. But a second change that they attempted, or that they have proceeded with, are changes on past service benefits. And so no longer, after March 23rd, 2011, will they allow a pension plan to receive past service benefits and create a large tax-deductible deduction by the corporation. This is very significant. It received a very strong negative response by the actuarial community. There was quite a strong pre-budget lobby that went into effect trying to convince the government of the unfairness of this, and it went on deaf ears. Then they proceeded with these negative changes to individual pension plans. So this really marks the end of a lot of interest that small business owners will have on individual pension plans, and reduces the ability of a small business owner in Canada to increase their tax-deductible retirement savings, which is really a sad day for small business tax planning. So if an IPP was on the radar for a taxpayer in Canada, which would likely be a small business owner, it's probably not going to happen going forward, thanks to the budget. And then finally, we have number 7, which is a revamp or narrowing in on the kiddie tax rules, and it's a bit of an aggressive move as well with CRA, because what's been happening in Canada is creative tax planning to really work around the kiddie tax rules that have been in place for a number of years now. And these rules, if you remember, prevent income splitting with a minor child and really put the interest and dividend income back into the parents' hands in many of the structures that could be created. So creative tax planning has worked around that, and capital gains do not attribute back to a parent. So there's been some strategies that have worked around the kiddie tax and made use of the capital gains opportunities. And so this federal budget takes a look at a specific strategy that was used as a workaround on the kiddie tax, and says, look, if you're going to be working around the kiddie tax rules by pulling capital gains taxation, then we're going to put the capital gains taxation back into the parents' hands. It's actually even a little bit more aggressive than that. So what that really marks for many Canadians is not just an end to some creative tax planning that's worked around kiddie tax, but it's a movement of CRA towards removing the capital gains exemption on income splitting. So that would be a really sort of sad day for Canadians if we lost the ability to use capital gains as an income splitting strategy. And so that was really what I feel are the significant technical loophole breaking sort of moves in this particular federal budget. And as you can hear, there were actually quite a number of quite significant changes in this budget. It was not a status quo budget, certainly for the tax planning community.